Hello, hello, everyone. Come on in. Awesome. We'll get started in a minute or two. Welcome, everyone, to this awesome webinar tonight. All right, attendees are flooding in. Our speakers and member VIPs are ready to share their insight. Everyone, welcome, welcome, welcome. My name is Maddie Roach. I'm XYPN's Director of Member Services, and I have the honor of hosting this awesome webinar every month. I was just telling the members on the line today that the first Wednesday of every month is my favorite Wednesday of the month because this is our opportunity to really deep dive into the minds of some of our members. And it's also a wonderful, wonderful opportunity for so many of our callers to be able to get some insight from the members who are currently running awesome firms, who are currently kind of defining where they want to go and making it happen. We have 3 awesome members on today. We typically only have 2 callers, but why not have 3, especially when we have representation from a firm that is a duo, and they happen to be sisters. So we'll hear from those 2 in just a moment. Kind of some housekeeping items. I do want to make sure that all of you feel free to submit questions during this call. Things get exciting when there's some questions coming through. I will try to pivot the conversation to make sure that we cover as much as possible, but I also want to be respectful of your time. So please do know that we will be wrapping this call up right at the hour. Towards the end of the hour, you will hear me begin to wind the conversation down. So if you do have questions, I urge you all to reach out to our members that are talking to us tonight. Any member that volunteers for this really is so frequently willing to talk to non-members offline and talk to them both about the experience of running their own firm, but what membership is like. XYPN kind of has a curtain over the forums. I think is pretty much the only thing that non-members don't get to experience. Otherwise, we are pretty transparent with our members. We want to make sure that our members are able to really talk about their experience. We haven't prepped anything tonight. We're just going to kind of follow through the agenda that we have, but thank you all so much for joining. I do want to make sure that all of you who do find inspiration from these members, if you end up joining XYPN, on the application, we ask if there was a member or 2 that motivated you to join. Let us know. Let us know if it was one of these members or if it was this call. We definitely want to know if things are working and if you are, there you go. And we want to be able to properly, of course, thank our members. So tonight's topic is the fees behind fee only, the hows, what, and why of choosing a fee structure. I suspected that this would be a hot topic, and surely it was shown it is through the number of submitted questions we've gotten over this week. So without further ado, let's just get started. Grant, would you mind leading us off with just a brief summary of your firm, where you're located, and when you started?
Sure. So my firm is Three Oaks Capital Management. It is domiciled in Oregon, and I reside in Sacramento. The reason for that is I started the firm in 2014 when I was living in Oregon, and my wife and I started having kids and realized we wanted to be closer to family, and then we moved down to Sacramento a couple of years later. So I basically have 2 offices. None of them are staffed. I have virtual people. But I sit in Sacramento, then I'm up in Portland a couple times a year seeing clients. So I've got a few more than 40 clients at this point. I work mostly with business owners and people in the medical profession in some way, shape, or form, and a lot of people that fit kind of both categories. So an orthodontist who has his own practice, or maybe like an ER, I have several ER docs that work a few shifts every month, but then they have a side business doing something in the medical field or other. And so the common thread there is working with qualified plans as a tool to reduce taxes, specifically now with 199A, 20% pass-through deduction and a lot of tax planning kind of stuff for high income people. So I've been around for about 5 years. My recurring annual revenue at this point is, I think, 210 or 220 or something like that.
Awesome. Cool.
Do you want me to keep going, Maddie? Or
no, that's a perfect intro. I think you covered a lot. Thank you so much. Taylor, I'm going to ask you to introduce yourself and maybe introduce Kailie, and we'll ask Kailie to describe a little bit too. But start us off, Taylor. Tell us where you're located, what firm you're running, and when it started and how you got there.
Sounds good. Well, Kailie and I, we work at a firm called Middleton and Company. Middleton is our maiden name. And essentially the firm it was an existing firm before it became a family firm about 2 years ago. We launched in 2017, January of 2017. So we are into now our 3rd year as a family business. But a lot of our clients actually have been a part of the business longer than we have. So we work with our dad. He has been in the industry for over 20 years. He's always been fee only. He used to work with a partner, and they essentially had 2 separate books of business. And when we joined the firm, his clients became a part of our firm clients. So we continue to serve his existing clients, and then we've added some additional services that are in an attempt to broaden the base of our clients to include younger, local people that we get to meet when we're out and about now that we've both moved back to our hometown.
Awesome. Love it. I've always admired the dichotomy of the clients that you're serving. And I want to talk with you guys about how you've kind of separated your fees too, because a lot of people actually wrote in asking, can we charge different fees for different types of people? So I think you guys are a great example. Kailie, tell us how you got into financial planning and into this family business.
Oh, that's a long story, Maddie. I'll go the short route. So I did not go to school for financial planning. I actually wanted to be in the State Department. And during a moment of transition, I decided to move back home and work at my dad's firm for a temporary stay. I was waiting for my husband to be stationed in the military. So it was supposed to be just like 8 months that I was doing this temporary thing, and I ended up loving it. So then we got stationed up in Anchorage, Alaska, and I worked for a firm up there, and that's how I got into financial planning. Great firm up there, and then being back home is always nice to do.
Wonderful. Was the firm that you were working at in Anchorage a fee-only firm?
Yes. Yep. RIA up there.
Awesome. Grant, did you start out in the fee-only space, or was this a transition for you?
It was a major transition. So I went to school. I got an undergrad degree in applied economics. I stuck around and went to business school, concentrated in finance, and then I got a job out of business school at Charles Schwab on basically an institutional trading desk. So I was on the securities lending desk at Schwab, and what that means is that if you're a client of Schwab and you want to sell stocks short, you have to be able to borrow them from your brokerage firm, because you're selling them. Someone else out there in the universe is expecting to receive them from you. You better get them the shares. And so all large brokerage firms have a desk that kind of arranges those transactions. That was a portion of what the desk did. The other side of it is, Schwab has millions of accounts. Most of them are long-term buy and hold investors. They have more shares sitting there than they do active traders needing those shares for short selling purposes. So we lend them out to other brokerage firms like Goldman, Morgan, JP Morgan, things like that. So I had a really nice career going at Schwab, but I'm kind of an entrepreneurial guy, wanted to start building equity in something that was my own. I wanted to help people more directly. Cool. And my observation at the time and still continues to be, is that there are a ton of financial advisors out there, but most of them are not fee only. They're influenced in some way, shape, or form by product sales, or are compelled to sell certain things or behave in certain ways because of the brokerage firm they work at. And it just seemed like the perspective of a fee only fiduciary is what a lot of people are looking for. And most people, I don't think, are able to articulate exactly that.
Yeah.
So it was a big change. I'd never worked in planning before. The prior role was trading and portfolio management.
Cool. Okay, so it was a big change, not only just into the fee-only space, but actually into the role of financial planner. Taylor, what has been your experience with the fee-only world? Was it something that you had entered in and never seen anything other than that? What was your story?
No, I didn't go to school for financial planning either. I got a business degree and focused in international business and IT. So right out of college, I worked in a consulting company doing change management on IT projects and loved it. So got a lot of, I don't know, exposure to big companies. I had a 401k. I started earning, more than a college student, and had to go through the decision process as I started moving up through the corporate ladder. I worked in Seattle, both in consulting, and then I moved in-house as a project manager for a big company. I lived and worked there for about 8 years before we decided, my husband and I, to move back to Vancouver, Washington, which is where we are now. And we decided that along the way we were going to take a little break, and we did the Peace Corps in the interim. Right. So while
Oh, they might have just clicked a bad button. They should be joining back shortly. Oh, that's a shame. They're probably swearing right now. Pardon us, everyone, as Kailie and Taylor get connected again. Grant, talk to me about how you perceived fee only. Did you know you were going into the fee only space consciously from that change?
I did, not because I knew anything about planning at the time. It just appeared to be a big opportunity from where I sat on the other side of the industry. Mm-hmm. I also had, some influence. My uncle is a CPA and was part of the reason I resigned and launched the firm. And his nudge was basically, hey, I do a lot of tax returns. I'm pretty knowledgeable in personal finance. And it's obvious that you should want someone who has a legal obligation to do what's in your best interest, who has competency and experience, maybe a credential in there, and is not compensated by anybody but you directly. And those concepts seemed pretty basic to him, but there continued to be a lot of people that don't operate in that way for whatever reason. So that was the push behind launching, and there was never another option for me. If I was going to do it, it was going to be in the fee only channel.
Yeah, awesome. Well, tell us about kind of, I think, what a lot of the callers are on tonight to hear about. You've been around for 5 years. Tell us about kind of the evolution of your fees, and that is kind of a loaded question, so feel free to break it up. But I would love to hear what you have to say about in terms of where did you start with your fees and how did you build from there? And then lots of callers submitted kind of really clear questions, so I have detailed questions that I'd love your opinion on.
Sure. So I mean, there have been a lot of evolutions, in 5 years, and I shared a little bit about where I came from, and I'd never worked as an advisor or planner before. I had no idea how to market services. I didn't have an idea of who, the ideal client was. I really started from zero, not having any idea what I was doing. But, my background in trading and portfolio management, I'm a CFA. I started out as more of an AUM kind of thing, without any planning. And it worked okay. I was kind of plodding along, in the first 18 months or so. But after talking to a lot of people and realizing what their issues were and what they were looking for help with, that's when I went back and challenged the CFP and done a more planning-oriented practice. So where I started with the planning, so I started out from zero doing just AUM, and I didn't have a minimum, which you don't usually do when you start.
Right.
And then I added planning on top of that, and what it looked like at first was a flat fee of $1,200 or $1,500. I can't remember what it was, for a comprehensive financial plan. If you want to work together on an ongoing basis, it would be AUM. I would help you execute the plan, and we would kind of go from there. Several evolutions later, where I've landed now, and I can get more detailed on the steps between if you like. What's working well for me now and where I have landed, and as an aside, I've never met any advisor or planner that doesn't continue to second guess their fees and has totally landed on the right solution. There's never a perfect solution. It's just based on what are you trying to build, who do you want to work with, and what is a reasonable and transparent way to charge people. That's probably what you should do. And so for me, I have a complexity-based annual financial planning fee. And it starts at $5,000. It goes up from there. The people that are finding me that I'm tending to work with have some complexity. And so there's a lot of hours involved in creating plans for them, and higher tax brackets and business issues and all those related things.
Yeah.
So I still do AUM. The way that I said it is if you're paying like $6,500 a year for planning, I apply an AUM schedule. If the AUM fee is less than planning, asset management is free. If it's more than planning, say you're paying $6,500 for planning and your AUM fee is $7,000 a year, you pay $6,500 out of income via ACH payments. I use Advice Pay for planning.
Awesome.
You pay the remainder $500 through their accounts, debiting their accounts directly.
Love it.
So
Awesome.
that's worked pretty well.
Yeah, great summary. Thanks. And I know that there's 4 years in between all those changes too. So Taylor and Kailie, I'd asked Grant to kind of explain where he started with fees and where he is now. So I'd love to know, what did you walk into in terms of your father's fees? What precedent had he set with those clients? And kind of in the short version, where did you end up? And Taylor, Kailie.
Sure. So at the beginning, when my dad had a partner, they charged the same way. They had both an AUM model and an hourly/project-based model. So those two. The AUM model was a tiered schedule, which essentially we've picked up and taken exactly with us. And then the hourly model, they would do like 401k reviews and things that weren't eligible for asset management under that model. And their charge was about $150 per hour. When we moved into this firm, we actually increased the fee to $200 an hour. And the reason for that was we wanted to encourage people to go more toward the relationship side of the business versus the transactional bit that turns into the hourly work. So we increased that, and that's another, what Grant was saying about your fees are constantly evolving, and as you're looking at your services and what it takes to provide value to your clients, we're in the midst of considering an additional increase to the hourly rate to $250. So that's not official or final yet, but as we're looking at our ADV update, that's one of the considerations for this go round. So building on that model with the AUM and the hourly rate, what we added was the comprehensive financial planning service. And that took a lot of time and effort to get to. We considered a lot of different models for how we wanted to work with younger clients, those that might not have assets for us to manage, and how would we want to engage with them. So we went through considering package deals, like if you were newlywed, what would that look like if you had just started a job? And it really landed on the fact that we didn't really want to pigeonhole any particular service. We wanted to be able to provide what clients needed, and we wanted to be able to use a tool that was consistent but malleable to the experience that the client was bringing to us. So the one we landed on was just the comprehensive financial planning service that was very much modeled on what we've seen across XYPN, where there's the upfront planning fee. Right now it's $1,500, and that is meant for us to be able to get a baseline plan in place. And how we've this has evolved since we set the structure up, is how to determine the monthly ongoing rate. So as part of us registering, we did have some pushback from the regulator that we needed to be able to explain why we were charging. We had set aside a $100 to $300 monthly fee. We needed to be able to justify that from a complexity standpoint. So we tied that to our hourly rate. That made the regulators happy. So again, our hourly rate was $200. So we felt like, okay, if we think this client will take less than an hour a month on average, then maybe they're closer to the $100. If we think it'll take longer than an hour a month, closer to the $300. So the evolution that happened was we didn't know where they stood until we did the financial plan. So we set the $1,500 as what we collected up front upon signature of the agreement, and stated that once the baseline financial plan was in place, we would agree then on the fee going forward. That's another part that we're discussing right now on how do we continue to define the complexity, and as we increase our hourly rate and discourage people from that model, because again, we want the relationship-based planning to happen. Comprehensive financial planning is relationship-based, so do we increase that or not? That's something we're looking at right now as well.
Awesome. Fabulous answer. Thank you for going in depth with that. Kailie, we had someone write in about whether or not people actually stuck with you after the first year. Have you seen any churn of your ongoing clients at all?
I think this is a good question and something that we are working through right now. We are coming up, so when I joined the firm, I joined last year. I had been working in Alaska, and then I joined my sister and my dad January 2018. That's when we really started building out this comprehensive financial planning option. And Taylor and I are heading that. Our dad does more of the investment management stuff. So we're coming up to a year for a lot of these clients. We have a total of, how many comprehensives? 8. About 8 couples that are on this kind of structure. And we don't know, to be honest, we don't know. Up until now, they've gotten a lot of value in the first year, but what we are finding is that their lives are changing too. So needs are changing, and each time we meet, we're going and saying, okay, our original plan was this. Do we need to make changes? Do we need to reprioritize? And we're finding that yes, we do.
Yeah.
And so we're not really concerned in year 2 that these people are going to drop off, but we are starting to think of what's the long term? How do we want to keep this relationship going? Are we okay with people leaving and then coming back?
Right.
And we're leaning towards yes. I mean, if we want you to get value,
yep,
we want you to have a good experience with us. And if you feel like you can go do it on your own for a little bit and then come back when something changes, we're actually okay with that. But it's evolving, and we don't know yet.
Yeah, awesome, good answer. And for a lot of firms who add the monthly retainer model in after kind of an established model, it does take a few years to even get consistent on the delivery of the service to even be able to have the data to determine if it's effective or not. So I totally see that. Grant, someone did drop in a note regarding your last answer about charging that last $500 of the fee from the AUM. Could you explain why that does pass the snuff for fee only?
Yeah, I see the question here too. So and I can't speak to what XYPN is trying to do. Maddie, you can chime in on that portion of it. But you know, my thought is that the spirit of fee only is objectivity based, and it doesn't matter whether you're paying out of income, like by handing somebody a check or sending electronic payment to you know, your advisor or whomever, or paying them out of your account, right? It doesn't really matter where it's coming from. The point is that the person you're working with, your advisor, is not being compensated in any way, shape, or form by parties or forces other than you. Mm-hmm. And where this comes up so much in across the industry is you have a lot of advisors are fee-based, and they'll charge you for their advice and management of investments, but then they'll also collect a commission if you purchase an insurance product through them. And there are a lot of, thousands of wonderful advisors work with that model, and it works for a lot of people. But I think the key is objectivity, and the spirit of fee only is not to have just necessarily a flat fee or give services away for free. I think it's that you're only compensated by clients directly.
Yep, that hits the nail on the head. XYPN does follow the CFP board definition of fee only, and they also are quite responsive. If any of you guys ever do have questions about, I've got this one little thing coming in through a trail 20 years ago of an annuity I sold, could I still be fee only? Those are perfectly appropriate questions for the CFP board. Members upon joining XYPN do sign a fee only agreement, indicating that they will at that point cease entities receiving any sorts of trails or commissions, or I should say, they promise that within 12 months they remove any trails or commissions sold by products during any relationships prior to that signature being put on paper. So I think Grant's summary is accurate. If you guys ever do have questions about fee only, I'd go right to the CFP board. NAPFA has a definition as well that deviates only slightly from it, but the real crux of it is that, is it a fee for service? Are you charging for the service that you're providing? Yes. Are you charging for products that you're selling? The answer should be no. But that doesn't mean that advisors cannot use the traditional AUM model and still be fee only. I hope that answers that question. I really do like the question, Taylor, about should we charge for different people? How, if you are unniched per se, or you want to do kind of a barbell approach that you guys have taken on, how do you charge different fees for different clients?
Yeah, to me, it's much more dependent on the service than it is the person. And the person gets to decide what service is of most value to them. Right now, one of the things that's been interesting in our evolution of our fee structure is we've got a lot of clients who are in the investment management model. And really what their expectation is that we manage their investments, right? That's what it's called. And as we are trying to really build out the financial planning service, because in all reality, having a financial plan in place helps us do better investment management. We are kind of circling back with some of the clients who have never gotten that service. And we are starting with clients, we are prioritizing clients at a certain net worth because they are paying us more. We're going to have to spend some time to catch up to get everybody a plan in place. The other way we're prioritizing are people who are at a particular life stage. So heading up to retirement, it's a really great conversation starter as we start to transition the way that the portfolio looks, and we start to have conversations about what are you going to do with your time now that you're not going to work every day. So those clients are still paying in the AUM model, and our intent is that is still the only fee they would pay. And that's also why we're kind of looking at the higher net worth clients, because they are essentially already paying for it. And then we need to decide, is there a level at which we want to set our minimum AUM so that we are getting paid for that without having to charge an extra planning fee. So that's for clients whose assets we're managing. For clients who don't have assets that they'd like us to manage, or that are in a 401k or something like that we don't manage, we have the comprehensive financial planning service. And that really, again, is based on the fact that they don't have assets for us to manage, but they want an ongoing financial planning relationship. As we've gotten into the business, what we're trying to figure out is how do we make it a very clear transition that our intent would be that you only pay fees in one of the two models. You're not necessarily overlapping. But we'd like that initial comprehensive financial planning structure to kind of lead into the investment management structure so that we can help with the implementation of some of those things and make it a long-term relationship where we can continue to add value that allows us to just actually implement things. And I don't know, the simple paperwork things that for us are 5 minutes, but we know the client gets frustrated with those things. Those are things that when we manage the account, we can take off their plate. So in any case, right now, if you're in the comprehensive financial planning fee structure, you pay just the upfront fee and the monthly retainer model fee. But if you want us to manage your investments, that we'll have a separate conversation with that, but that's not the intent of that model.
Great, thank you for that.
Can I expand on that a little bit?
Yeah, please.
We've experimented
Yeah.
a little bit, and what came to that is we do have some clients where they are in two separate fee structures. So we have one where we do planning and he does the ongoing monthly, but he has like $12,000 for us to manage. That's below our minimum AUM. Yep. But because he's doing the comprehensive, we have agreed to manage that money for him, and he pays the AUM fee on the account that we are managing. So he's in two ways. And the reason we've kind of leaned that way is that we have a lot of comprehensive financial planning clients where we do asset allocation, and then they'll come to us and say, well, do you have specific funds? And we'll give them specific fund recommendations, and then we find out, well, they're in the retail side versus the the advisor side, so they have a higher minimum, or they can't access it because it's a closed fund. And so these are some of the challenges that we run into when we're mixing the two structures. So we're still kind of developing that out, but I do think Taylor's right when we say our ultimate goal will be to move our what we call now comprehensive financial planning clients into our kind of investment management service, with the idea that it's not just going to be investment management anymore. It's actually going to be a holistic thing that includes that investment management is a part of the larger plan.
Oh, I love it. I love the diversity so much of how members charge. And despite it being kind of that never static thing in our members' lives, is niching and fee structures seem to always be the things people are changing. There is so much diversity among how our members do charge their clients. Grant, I'd love to pick your brain. There were several questions submitted and one just popped up. What's your take on net worth rather than AUM? Do you have an opinion? Is there a bias that we should think about? Any conflicts of interest?
I mean, overall, there's, like I was saying earlier, there's no perfect fee structure. I think net worth or a combination of net worth and income make a heck of a lot of sense. I mean, there's always going to be conflicts or little nuances of whatever fee structure you're working with that is not going to make it perfect, right? And with an AUM fee structure, the classic one is, well, you get an inheritance. Do you pay it on the mortgage, or do you put that money to work? And obviously the advisor is going to be compensated more if you put it in the portfolio because they get paid on it. Net worth, you don't have that same conflict. But there are a lot of, so let's say you move forward with a fee structure that's based on net worth or income and net worth. There are a lot of sticky things that come with that I think most people don't appreciate when you're embarking on that. For example, now you have to discuss the fee every couple of years as things change. You also have to decide what you are including in that calculation of net worth, because I guarantee you, if you're including all assets against all liabilities, you're going to have a lot of people really strongly push back on using the equity on their home being contributed to your fee. Because, maybe there's a little bit of advice in there, but how much are you actively doing on an annual basis? Closely held businesses, there are a lot of things that pop up that just really make it a muddy situation. If you're trying to find the one structure that reduces all conflicts and is most transparent, I think that's a really good option. But it comes with its own challenges. It's something that I thought about for a little while and halfway tinkered with, but I didn't want to deal with the complexities. And I might tinker with it again in the future. I don't know. I mean, I think everybody, this is a constant struggle for people.
Yeah, and that conflict, I think just because there is a conflict, a potential for a conflict, doesn't make it not fee only. It just means that you have to be now a fiduciary, right? Like you can't, you have to literally ask yourself, am I going to help my client achieve their goals, or am I going to help my client achieve my pocketbook goals? So that's a fiduciary question, I think, less of a fee only question. Taylor, do you agree with that?
Absolutely. And actually, when we saw this list of questions, one of the things we were talking about too is the challenge of getting your client to continue to disclose all of their assets, right? So if they, I don't know, get a big bonus or something like that and want to put in an account so that they don't get charged based on that, and then the idea that Grant brought up where you have to reassess it over time, there are some behavioral things that are challenging. From our standpoint, Washington State doesn't see it as a valid way to charge fees, so it's off the table for us.
Interesting.
But that's really the only reason it's off the table. It was something that we looked at and proposed, and we were very quickly told that right now that's not an acceptable fee structure for our state.
Yep, and that is so very common, and our compliance team does really understand kind of the different nuances between states. It's amazing, not just the states differ, but the actual regulators within the states differ too. And in Washington State, there's actually two separate bodies running the whole thing that don't actually communicate. So to that point, Taylor, I would like to address, there were a few questions about the monthly retainer model being possibly challenged by regulators. Have you experienced that? What is your experience? And then I will speak a little bit to that too.
Yeah, when we got registered, one of the things that was very clear in our response back from the state was they were going to let it go as long as it was based on our hourly rate. So the monthly rate does have to be tied to our hourly rate. And for that reason, we do track hours for our comprehensive financial planning clients just behind the scenes so that if ever we had to defend the monthly rate, we could do that. We haven't had a scenario where we have not earned the fee. We'd have to figure out what we would do. In fact, it's good for us to see that we are actually spending a lot more time than our hourly rate would allow us to charge. But what's your thought?
Oh, sorry, I'm totally commandeering this. I do have one client where the upfront fee he paid, and then we realized that the baseline plan was not what he needed at first. And so I tracked my hours until I earned the fee, the upfront fee, and then I gave him the option to either continue with the ongoing or to go hourly. And he chose to go with ongoing for the very purpose of having me hold him accountable. So there was one situation where we didn't earn it the way that the way we had with all the others, but we still had a way to defend it. And if ever I think the regulators came, they could see how that was tracked and the decision.
I was going to say one thing that was really helpful upon the registration and as we were going back and forth with the state was looking at ADVs that had already been approved in our state. So that's one of the benefits of being in the expert planning network and having contact with other advisors in our state. We were able to look them up on the FINRA site and actually download their ADVs, and then we could talk to them about that registration process they had. So that's true for every state, that you can go up and see what's already been approved. And it also is helpful in the conversation with the regulator when you can point to scenarios that have already passed through registration.
Awesome. Great advice. And our Director of Compliance, Scott Gill, has written numerous blogs on kind of regulatory concerns around the monthly retainer model. What we've seen in Washington most recently is not an outright denial of the model by any means. It's simply kind of caveats and things that need to be added on if the service is going to be provided, for example, charging in arrears versus advance. So things like that. Grant, I love this question. How do XYPN members handle recommending and providing insurance products to your clients in need?
Good question. You know, it's comprehensive financial planning often gets kind of lumped together, and I think a lot of people assume that if you're in this business, then you have to do full-scale comprehensive financial plans for everybody. And I don't think that's the case. You don't necessarily have to advise on insurance if you want to deliver a service that doesn't include that. I think most advisors out there do as part of their package because, you know, they're trying to provide a comprehensive service and help their clients get to the best place for them, and that, you know, usually includes insurance planning. The way I do it in my practice, and the way I think most advisors probably do, is there's a quantitative side to it. And so, you know, if you have a young couple, you're doing like a human life value analysis where you want to quantify how much life insurance either spouse should have in order for everybody to be 100% protected if one or both of them goes away. You can also model out the cash flows on a year-to-year basis of what does it look like if that happens? How is everybody else going to be impacted? Typically, I start there when I start creating comprehensive financial plans for clients, and it's totally their decision of whether or not they want to insure or not, right? Some people are comfortable not mitigating that risk. Most people decide to buy life insurance. I'm not writing the life insurance policy, of course, right? So by virtue of being fee only, I'm not licensed to sell insurance, but I do want to help my clients get almost all the way there. And the way that I do it is I work with, there are a couple different insurance brokerage firms out there that specialize in working with fee-only advisors who allow me to make the recommendation and give the advice. and then they'll take the client's medical information and then go find the least expensive term policy or whatever it is that we're trying to do across all the carriers out there. And so that there's often a common I think misconception that if you're not licensed to sell insurance, you are leaving your client in a bad spot because you're not helping them obtain what they need on the execution side of the plan. And I don't think that's necessarily true anymore, because there are outfits like LLIS specifically that are really good in working with advisors like us, and there's no, clients are not hung out to dry, left to their own devices to figure it out on their own. You're helping them get all the way there.
Yeah, great point. And that's just one of many things that you need to go to other experts to help support you in the delivery of your plan. So good distinction there. Kailie and Taylor, any thoughts on insurance products, how you support your clients and making sure they have the coverage they need?
We have a similar approach to Grant in the sense that if we usually do some sort of assessment, and what's nice about the comprehensive financial planning is it doesn't have to be in that baseline plan. It can be something that is, okay, in month 2 or month 3, after we've gotten your acute issues settled, let's now work the plan and figure out some of the other vulnerabilities that we can help you protect against. The one that also comes up beyond life insurance is long-term care insurance. So being able to point people in the right direction for that, and knowing when is the right time, like what age does it typically make sense to start considering it? What are some of the pre-qualifying questions? We do like a quick assessment in that sense. But I would say insurance is one of those industries where it's just like financial planning, things change all the time. And we actually feel more comfortable saying, hey, there's an expert for that, and this is somebody we've worked with, we trust. And especially around long-term care, there are lots of new products coming out, like hybrid life insurance and long-term care that we can't keep up on. So it is way better to send them to somebody who happens to know what might be available.
I so appreciate that response. That really it flushes out my understanding of that real relationship, that there is actually an expertise here. We do at XYPN, we have partnered with LLIS since nearly day one of XYPN. They've been our national kind of founding sponsor. So they're totally fluent and they in fact niche on, they have a niche of fee-only advisors, helping our fee-only advisors be able to work through the insurance needs of their clients. So that is part of membership. That relationship kind of just comes with it. Thanks for your thoughts on that. Another question that really piqued my interest is, how much do your clients really know about fee only? Do they get it? Grant, how about you?
That's a good question. I'd say a lot of my client, like a lot of prospective clients who find me, are finding me because they're looking for a fee-only advisor with a certain expertise. And so they look for, background or credentials or something like that. And so those people obviously know what fee only is, or at least they know to look for one because they read it in an article, or their uncle told them to look for that or something like that. But there are, I would say that the people like that I talk to, like in my circle of friends and socially and just the general public, has by and large no idea. And it gets really muddled. Fee only really gets muddled together with fee-based. Mm-hmm. And I think the general public would probably think the two are identical, which, they're not, of course. Right. But a lot of the people that are finding me, and I've noticed that over, maybe it's because my website's a little bit better, I have a few more years under my belt, but each year as we go along, there are more and more leads coming in through like NAPFA and the Fee Only Network, or people who are specifically searching for those characteristics.
Fabulous. Kailie and Taylor, thoughts on that?
I would agree. Most people that find me through, I get a lot of leads through XYPN. That's probably where the majority of people who are interested in our comprehensive service are coming from. Cool. But they are not saying fee only. What they're using is non-commission. So that's the language that they are using. And they're not wrong with that. So when they come in, we kind of explain what that it goes beyond just that. But but I agree with Grant that most people that I meet in the street, you know, or in my social things outside of work, they don't know the distinction. But people who are finding me and specifically looking for somebody through NAPFA, XYPN, are aware of it. So it kind of depends on where they're coming from. I would say referral sources, most of them know, because they're being referred by existing clients.
Mm-hmm.
But I would say even some of our clients probably are not as well educated on it as we would hope. Like people who are paying us, I don't know if they know exactly how we get paid. So that's something that we're working on internally, and also we appreciate XYPN getting that out there too.
Yeah, I think that that's a shared mission among, I think, all of our members and all of our staff and many of our partners, NAPFA and the CFP board, to really get out what the definition of fee only is, because it does trip people up. In fact, it trips advisors up all the time. We get a lot of members, or not members, but folks saying, well, I'm 99% fee only. Well, we got to really look at the definition to understand that, to make sure that that's actually a true statement. So let's answer just a couple questions about the nuts and bolts of charging fees. Grant said he was using Advice Pay. Taylor and Kailie, how do you charge fees for your clients?
We just recently got on Advice Pay as well.
Awesome.
So this past month was the first time that I did it, and I think it's going to be a lot easier than
Yeah. So that's for our ongoing financial planning fees. And then for AUM, we, for the majority, I think we have one client that pays by check still. Majority of our clients allow us to deduct fees directly from their account as the assets under management model.
Yep. Awesome. 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 I appreciate this question from a caller tonight. Is it true, or isn't it true, that you can't pay financial planning fees out of IRA accounts? Taylor and Kailie, you know that answer? Out of retirement accounts.
I do know you can't pay asset management fees for accounts other than the IRA or you can't pay a brokerage AUM fee out of the IRA. It can only pay for itself. Right. We do have clients doing the opposite though, that they have a brokerage account that pays for all accounts, including IRAs. And really that comes down to that. I think they're not wanting to be a tax loophole because it's pre-tax money, so they don't want pre-tax money to pay for more than the pre-tax account. Other than that, the planning fees, we don't charge that way, so I don't know.
I would be hesitant to answer that question, but what I will say is, like Grant, the majority of all of our financial planning, they're just paying out of cash flow, or so they pay. We invoice them, and they just pay either through ACH or they can do it through credit card. So that's how they're paying for it. I don't know.
Yeah, I don't know. That's a good question.
Yeah, awesome. Well, I didn't mean to stump you on that. Grant, do you have any comments on that?
Yeah, I think that's accurate. You are not, just like you're not able to pay asset management fees for another account out of one IRA, you are not supposed to pay for financial planning fees out of an IRA either. You're only supposed to pay for the only deductions from the account should be asset management fees for that one account. This is an area where I don't think anybody has ever been challenged on that, to my knowledge. And I'm not, totally up to date on case law in this area or anything, but typically, with the financial planning industry, everybody charges like 1% of AUM. And historically, that's been for an investment management centric service. My understanding is when you are holding yourself out as a comprehensive financial planner, and that 1% also covers all this other stuff, as well as the discretionary management within that one account, the IRS would have a case against you if they decided to challenge it. They've not yet, and with the majority of the industry still kind of set up that way, I don't think it's come to light. I don't want to charge, like if I have a client who is paying me, and that's when I mentioned it earlier, the $6,500 like planning fee versus $7,000 AUM. This is why I have clients continue to pay the bulk of their fee through ACH, and I'll take the difference via a debit from their account, because I don't want that to be an issue. And I think that's a really good point to raise.
Yeah, yeah. Thanks for that. I'll ask you this, Grant. Could you speak to why a payment processor like AdvicePay is compliant?
Yeah, this is an area where I don't want to spend the time learning all the ins and outs.
Yeah, sure.
So the alternatives out there, you can go through QuickBooks. They have an ACH payment service, but QuickBooks will not technically allow financial planners to use it. And so I used it for a little while, and it just kind of went unnoticed. And then I switched to AdvicePay before anybody figured that out. But there are countless planners who have used QuickBooks payment services and then gotten kicked off the platform. And all of a sudden they have to find something totally new for all their clients, which really sucks.
Yeah.
The other alternative is something like, Pay Simple or one of these other payment processors. I have no idea on a state-to-state basis what might make that compliant, but I do know that there are hoops you would need to jump through in order to use it. And this is an area where, I pay a little bit to use AdvicePay, but I don't want to get into those nuances at all. And it's a good thing to pay to have somebody else take care of.
Yeah, and that was the motivation behind Alan Moore and Michael Kitces creating AdvicePay, was that the vendors that currently were in the market were not making it compliant for our fee-only advisors. So there is a question of custody with those other payment processors, that you had the ability to possibly change the amount you were going to charge your clients without their approval. That would trigger custody issues in a lot of states. Have you ever, or Taylor or Kailie, do you have any comments on why AdvicePay is compliant for you? You don't have to.
In terms of compliance, no. For ease, one thing that it does allow that QuickBooks doesn't. We were using QuickBooks for a period of time too. We didn't get kicked off the system, but we're now on AdvicePay and we feel really good about it. What's really nice for the client is that they agree to a subscription, and that is a way for them to automate. And we can't change that subscription without their knowledge. So they have to agree to be able to sign up for that subscription. I just got an email from AdvicePay last week that was explaining how it was compliant, and I read the first few lines and was like, awesome, great, I'm doing what I'm supposed to be doing, and that's as far as I went. But I know my clients really like it, because instead of having to proactively pay an invoice on a monthly basis, they can set it. It's part of their financial, we're telling them to automate everything else. Why can't they automate paying us? So it doesn't answer your compliance question, but
no, and I wasn't looking for anything in particular. I do think we hit the high points. It is the login actually that makes it compliant. So I know a lot of advisors are like, oh, I don't want my clients to have multiple logins. Well, it is what makes it compliant, is from what I'm understanding of the compliant aspect of it. So let's move on from AdvicePay and how you actually get the charge, get your fees every month. We are quickly approaching the hour, if you can believe it. I feel like we just started. So let me just pause before we proceed and make sure that all of you do know that you're invited back here next month again for another webinar. This again will be on the first Wednesday of the month. Next month is going to be themed all about lifestyle or enterprise practices and what's best for you. What that means, are you a career changer that's a stay-at-home dad that only wants to work part-time on a financial planning only business, or are you someone who is going to try to take over the industry with multiple advisors, multiple branch offices and things like that? So we're going to have 2 members on the call next month talking about those things. So please do feel free to tune back in. I do want to make sure everyone is reminded that if any of these members on tonight's call, Grant, Kailie, or Taylor, were the reason that you decided to join XYPN, we want to know. We want to know because we want to know that these calls were valuable for you and that we helped you get your questions answered, but also because we want to properly thank the advisors for their time. So all of them have been willing to share their email with you, and one of our XYPN staff members is sharing all of that in the chat. So with that, let's get going with the last 6 or so minutes of our call. I really want to talk about the idea of changing fees. I know we talked a lot about that it has happened. Is it difficult for your clients? Is there a certain threshold you can tick it up without them noticing? What's the process for actually changing your fees at your firm? Taylor and Kailie, I'll let you start.
So the one that we've changed specifically that we kind of carried over from the previous firm was the hourly rate. And people noticed, but because it was on a transactional basis, it was just, as we signed the new agreement for the new scope of work, that was the fee. And I'll be honest, not one of the clients blinked an eye from 150 to 200.
Yay!
So really didn't. As we move from 200 to now potentially 250, we are starting to communicate that to clients just to let them know. And projects that have now started under 200, we're going to finish under 200. That was the fee model we agreed to in that agreement, but new agreements will be written with the new fee. So that's been our experience in the change. The AUM side hasn't changed. It's the comprehensive financial planning that will be the next challenge. We'll figure out what that looks like. We haven't done it yet.
Awesome. Awesome. I love the apprehension members have about emailing members about fee changes. It just isn't an easy conversation, but so many times, in fact, I really never hear a member say that they regret raising their fees. In fact, so many of the stories tend to be like, they didn't care. They thought I was valuable. Grant, over these past 5 years that you've been running Three Oaks, how have you communicated the changes and what were the responses of your clients?
I've had both, people, some will say something like, yeah, I mean, we totally get it. We're surprised you haven't done it earlier. Some people balk at it and you lose, clients. I think this is one area where if you look at the numbers and, put on your business management hat for a second, if you double your fees and you lose half your clients, now you're making the exact same amount of revenue and you're doing half the work. And I guarantee you that if you raise fees and you're, obviously respectful to your clients and you're doing it thoughtfully, you're not going to lose half your clients. And when I've gone through that process, I got really good advice from JD Bruce, who runs Abacus. I sat in on a session he had sometime a couple years ago, and he said something like, phrase it in a way where you tell people that you're changing fees and then you tell them what the new fee is, and then you just shut up for, a minute and let them have a response. And if they really have a problem with it, tell them, well, I really like working with you, and you can phase it in over time too, and say, look, if your old fee was $1,000, it's now $2,000. Let's do this over a couple of years. If we do it over 3 years, we'll raise it 33% each year, and just kind of ease into it. And so you don't have to be, if you have decided to raise your fees and you're trying to figure out how to go through that, you don't have to be perfectly rigid, and you can, apply it across the board from day one or phase people in. There's a lot of flexibility with regard to how and when you go about it.
And what an honor to your clients to have an advisor be willing to do something like that. Like if it really was stressful for them to have their fees raised, to have you be able to say, let's do it gradually. That's actually a really unique thing I've heard from you. Thank you so much for that. In closing, I think just through this conversation, we've learned so much about fees and fee only and the hows and whats and whys about it. And to Alan's last question of the podcast always, what is one thing that you guys would change? And let's make it spicy tonight and ask, what would you have changed knowing what you know now about your fees, if you could? Grant, I'll ask you first, and then Kailie and Taylor second.
What would I would have changed? I don't know that I would have changed a whole lot. I think with, one of the reasons, and you look at like the XYPN benchmarking reports and all those things where I think 100% of advisors raise fees, a couple years in or something like that. Every single person raises fees. Nobody goes the other direction. It's just, it's one of those things where you will gain confidence with more reps, and running more people through your process and gaining competence as a practitioner. And there are always going to be several iterations of how that all works based on what you're trying to do. I think if I had it to do over again, I would be a little bit more thoughtful about who do I really want to work with? Who is that perfect client? And, what are their problems and what is the most logical way to work with that person? If you're trying to work with early stage entrepreneurs, AUM is probably not the way to go, right? You probably want to charge them a flat fee that's based on what they're trying to do. if
Yeah.
you're trying to work with retirees, AUM's a really good option. So, I mean, be more thoughtful about who that target is, and then apply the fee that works best for them. And don't, you know, sit at your desk and speculate. Go out and take people out to lunch and ask them, right? What would be most reasonable from your perspective? How do you think I should set this thing up? Those types of questions.
Great answer, Grant. Thank you. Taylor and Kailie, how about you?
I think the one thing that is coming up that we're now thinking maybe we would redo it is the complexity side of it. So we've set the upfront fee that we can always decide if that's the right amount that we want to charge up front. But the $100 to $300 per month based on complexity has caused us to have an interesting conversation with clients who don't think that they're very complex. And so what we've struggled with this, because by the time they've come to a financial advisor and want help, usually there is something there that requires some expertise or whatnot. And what we're finding is that we really aren't doing any $100 per month clients. So I would feed off of what Grant said, and I would say, if you can decide who you're serving and know what level of service would be valuable to them, and then figure out that one number that would make sense for you to provide the service and you think makes sense for the person you're serving, that takes that complexity and judgment out of it. So that's something we haven't implemented yet. We're currently still in the complexity model, but I think that might be where we're headed.
Cool. Awesome. Cool. All right, folks, it's 8 o'clock. Who could believe it? It's 8 o'clock here in Bozeman, Montana, and it is 7 o'clock where you guys are out on the West Coast. So thank you all so much for your honest feedback, your openness about what you guys have built. And really, I think the callers spoke for themselves with the number of questions they submitted about how important this topic is. So callers, feel free to bring the conversation over to the VIP group. Feel free to reach out to any of these advisors. Feel free to reach out to our XYPN team. We're always here to answer questions and help guide you wherever you need to go. But cheers to all of you. Have a great and safe Wednesday night. I'll see all of you back here this time next month for a conversation about what kind of lifestyle or enterprise practice you guys are going to be building. All right, everyone. Thank you so much, and have a great, great night.
She did.